Yeah, good evening to all. Welcome to this webinar on the topic being financialization of saving, the new mantra to stay invested. We have seen the last 2 years be arguably the best for the retail investor in the sense of participation. This was one of the biggest positives of demonetization when we saw massive amounts of inflows into equity markets, given the necessity of putting your cash into savings account and so on. All that has seen the best equity market inflows in the last 2 years, which we have not seen in the last 30 years for the mutual fund industry. It also means that this money is here to stay. Going by anecdotal evidence, we think the shift of returns from gold, fixed income, and reality is now ebbing, and we have seen huge amount of positive guidance and positive inflows into the equity markets. This phenomenon is here to stay. We've seen arguably the most volatile last 8 months in the equity market, starting from the 1st of February when we had the union budget. And if we saw inflows, anecdotally, the last month of October was supposed to be the worst, where the equity markets corrected massively. And with crude at 86, bond yields at close to 8.1, and the rupee at 75, you would have expected that locally funds would have also been on the sideline. But if we see the numbers, you got the maximum amount of SIPs of almost 8,000 crores in the month of October, and that is telling you that the pattern of investment is not changing. In my own interaction with a large part of the retail clientele, they are very confident, and they are actually convinced that equity as an asset class for the next 3, 5, 10 years is here to stay. So for us, the new mantra is definitely financialization of savings, as we see our 130 crore population now starting to see 3 to 4% of equity inflows in a country where gold, real estate, and fixed income has been a dominant factor. This 3% is now just trying to tell you that we have matched all the FI outflows for this year and still stayed positive, which again reassures that these inflows are here to stay. The other caveat being that in a time of volatility, they have not deserted the market. They have in fact put their money where their mouth is, and you should be taking advantage of this, because this trend in the short run may not see too much appreciation just by itself, but it's telling you the quantum of money which can over the next few years locally come will match up to all volatility caused by foreign investors, who are generally considered people who move with the trend or fair weather friends. The glass is half full or half empty. The Nifty has been a relative outperformer of 4% in a year to date basis, whereas other markets have seen a huge correction. And in the emerging market basket, Nifty has still held its own. This despite the biggest fiasco of ILNFS, which was one of the largest shadow bank and was nearly our Lehman Brother moment, which government very skillfully averted, and which has caused a little bit of pain in the short term commercial paper market, where we still see a mismatch in the asset liabilities. However, I think most of the NBFCs, most of the banks are now ready to put their money and try and take advantage of someone's pain being someone's gain. At a time when the Nifty has seen a sharp correction of 10,000, we are actually speaking on a day where the month of November has been the best month in the last 2 years. From 10,020 on 29th October, today we hit 10,900 on 30th November, and almost 10%, almost 9% on the Nifty will mean that stocks have done extremely well. The market is telling you that in this fiasco of rupee at 75, oil at 85, bond yields at 8.2, you would have expect that globally, with also the other caveat being trade wars between India, US and China being at the forefront, gold would have been a good defensive asset. However, gold has done nothing. And if I can, put my, if I can stick my neck out, I would say that once we are through with elections and the uncertainty, and if yields remain at the 7.7, then definitely more money will shift from gold as an emotional asset to equity markets. So why should not you be invested? It's not easy to time the market, and neither can you be a precision master of getting in at 10 and exiting at 11. The idea here is that long term equity is an excellent asset class to be here, and we think that this is just the beginning of a very, very longer term bull market for the Indian markets. At least we think the next 3 5 years we'll see firstly political stability return again for the next 5 years, earnings catching up, which has been missing for the last 2 years, and we've seen green shoots of that. We think crude and oil, crude and yields, and the rupee being stable, we should see much more foreign inflows going into the markets at a time when when we've seen gold do nothing. Even the US yields are now starting to soften, given that Fed Chairman Jerome Powell has also sounded dovish and may actually not end up with three but two hikes in 2019. This has seen a lot of money flow back into the US markets, with the dollar becoming weak, and I think it makes the case of emerging markets outperforming in 2019. Uh, in the short run, maybe we have pulled back very smartly. You've seen the month of November has been the best inflows from foreign investors, which have again told us that they have also been privy to the fact that the rupee stability and oil at 58 was not on the cards for anybody, and that has taken most by surprise. What's the way forward? We still think that the state elections may cause a little bit of a blip, but that could last from 2 days to 2 hours, and the general elections will be the other caveat. But if you look beyond that, earnings, participation, local flows, macros turning positive, and earnings in the sense that for the first time, Larsen and Toubro, Cummins have all guided on the upside. These are huge behemoths which are more prone to the manufacturing side, and which is telling you that the GDP is definitely going to be seeing an upside kicker, given that capital expansion, which has only been there from the government, would now start to flow from the private side. Uh, Thirdly, I think that these inflows are going to be here as they are not going to. So the local investor has got his ideas and his investment policies firmly behind you, and he's going to match out to anything on the FI side for as a selling. So if we've seen, even in the worst of months, the SIPs do extremely well. Just to add, I would we want this to be more of an interaction, and if you have any queries or questions, please keep putting it on the chat, so I can keep answering that as we go through this. The idea would be that we can have an impromptu discussion on anything which you have regarding the markets, both on the derivative or on the equity side, and what you require as a query on stocks also. So kindly keep that coming. The other positive would be that we think that private capex is definitely going to expand. President Trump's protectionism has seen arguably the best rally in commodities in the last 1.5 2 years. That could be here to stay. And if yields are going to fall there, then equity becomes a very good asset class in the short run. Emerging markets have been decimated more so by the dollar strength, and we think that is definitely overdone. In fact, we would see that dollar could be on the weaker side in 2019, with emerging market currencies, bonds, and equities being the large outperformer. China has become a bear market, has entered into a bear market, and there has been a lot of talk and clout on what the Chinese economy and the debt on that side is. So that again puts India into a sweet spot given our consumption, and like I said, the mantra being simple, that financialization of saving is here to stay, and that should be the mantra to stay invested. I think we can take it from here on a few questions, and if you have any further queries, we could take it from there. We are open now for questions. One more statistic I would like to give you is that the Nifty saw a correction of almost 1747 points from the highs to the lows, to the recent lows of 10,004. And we've done a 50% retracement at 10,877. A 61% retracement would be close to 11,069. Whereas the bank Nifty, which saw a correction of almost 3,600 points, has actually seen, they have climbed back to 0.61 of their fall, which telling you that the banks have actually outperformed, given that smart money bought the fall in banks on the back that crude and rupee would, would start to see traction on the upside. On your Nifty December view, like I said, 11,069 is a 61% retracement, which would see a lot of resistance for the short run. Secondly, we have the 11th December verdict on the state elections, and this poll is all over the place of 3-2 and Congress being and so on. It may have an effect for a few days, but the other point of which we must ponder is what's going to be there on the G20 tomorrow. That could dictate the trend further, given that if there is a strong resolution from President Trump and Premier Xi on the trade war, that could be another big icing on the cake for most emerging markets and global markets, which have been more subject to President Trump's tweets rather than the actual fact. So I would say that December, if we do cross this 11,069, then we could have a shot at 11,400. 10,700 now becomes a range where all dips will be bought, since foreigners are very, very actively looking to buy all the falls. Your view on India Glycol is that India Glycol is in is in molasses, and the other product which they are coming out with has seen a very, very positive response. That's the residual part of the molasses. We think that that stock can be re-rated once they find a bigger market for that, as as a vertical that will continue to hog the partial credit, and we think that this is a definite stock to be re-rated on the upside. It has been one of the mid caps which had to bear a lot of the pain because of the mid cap sell off. But every 3 years, in my 28 years or 30 years, I've seen after every 3 years you see this 1 year of mid cap huge underperformance, whether it was for certain internal facts of SEBI on ASM and so on, and the mutual fund flows being slightly distorted. We think next year could be a very, very good year on the mid caps. On India Bull Housing, again, it has been one of the largest players in the housing market and has to bear. It is also a big participant in the commercial paper, and there was a definite issues regarding the asset liability mismatch, where they lent for the longer period and borrowed in the short run. They have been definitely affected by the commercial paper fiasco and the ILFS default. But the management has guided. They have raised almost 32,500 crore rupees in the month of October. They have reduced their commercial paper obligations quite a bit. They are in the process of selling a large part of their bond portfolio, loan portfolio. They've sold 5,000 crores. They've sold in this quarter. They're looking at selling another 15,000. The valuations are 2x price to book. India Bulls is now arguably at a 3-year low. So I think if you can nibble into some or make a sip, you could be laughing your way to the bank, given that yields are falling, and we think that by the next 2 months you should see a lot of ease on the commercial paper with longer term borrowings coming back. Added to that, today the government announced a very big relief on the NBFCs or the housing finance companies, which again for India Bulls would mean 80% of their book on a 5-year, above 5 year, can be re-looked at, and that would add much more liquidity to them. The other stock which you asked me is on refinery stocks. So now look, refinery stock on the OMCs, I would like to say that they have definitely seen a huge bounce from the one-time low they hit because of the 1 rupee hit which they took. Even though crude has fallen sharply, they have not been able to move in tandem. Though HPCL has risen about 40% from its recent lows. The only unknown here is the rhetoric on the elections and the which normally preludes any election, that there are freebies on the card. I think this is a misnomer. Government has been very firm that all the OMCs have been in tandem in raising prices whenever it was due. And I think by next year, once these elections are over, you should start to see outperformance. In the short run, they will be subject to crude prices and profit booking by most because of the huge rally we've seen because of that one rupee fiasco. Infosys definitely has been one of the better performers, but the only caveat here is for IT that. The rupee, which was a tailwind, has now become a headwind. And if you left the rupee, actually their margins didn't see too much of accretion when the rupee hit 75, telling me that most of these companies are well hedged. And even on the way, when the rupees get stronger, it's a myth that they will lose. They are more or less market neutral to major movements in the rupee. It's business as usual. They need to show some inorganic growth, given that both them and TCS sit on huge cash piles, and if that can be used advantageously, then they would definitely be good performance. The other caveat here is that at the time when you want to generate alpha, then banks, consumption, capital goods, these are the stocks which can actually give much more delta, given the twin benefits of rupee, oil, and bond yields are in their favor. So Infosys is a market performer, and definitely along with TCS, HCL become very good portfolio picks. Tata Porter, unfortunately, has been one of the, it's called by catching a falling knife, and the falling knife has cut all hands. Despite the fact that its valuations are the cheapest auto stock globally, we think that China is definitely the hidden, icing on the cake for Tata Motors. And if we start to see some action on the tax relief which they've given, if the impetus comes, plus we get some relief on the trade wars, then Tata Motors should start to see more traction on the Chinese business, which actually could cause some of the reprievement of the valuation. Stock has been relatively cheap, but you have to have a much longer period because their CV sales locally are doing well. It's the fiasco in China and some parts of Europe which has to catch up. On Seat tires, I think Seat, Apollo, and MRF should be relative beneficiaries, given that rubber SPT prices are sharply lower, crude oil has corrected sharply, and we think that the low sales on auto also may be coming to an end. We've had a late Diwali. We think December onward, you should see much more traction on auto sales. And as a corollary to that, I think tires should do well. All the three deserve to be relooked. They've made a bottom, but you have to be more strategic in buying them on a SIP or buy a fund which owns them. On Ujjivan Finance, it's been unfortunate. Ujjivan and Equitas both have had to bear the brunt of this, emphasis of RBI to create they've given a timeline on creating a bank. They both have the banking scheduled banking license, and that has unfurled a lot of feathers. They are well owned by institutions. They are very well done microfinance companies. But in the short run, I think they've had to bear a large part of the pain because of the uncertainty or the timing. They've assured that they would be looking at enhancing shareholder value. Right now, I would say do not try and bottom fish, but just let's wait for more color from their interaction on RBI and the company. The microfinance space is in a very sweet spot. They are both scheduled banks, and I think that going forward, we should start to see them gain at the expense of the NBFCs. Arvind Mills has been a relative outperformer, and now we have the demerging of the real estate from the textile business. We think there will be immense value being created over a period of time because textile has seen India be a relative outperformer, and we are now almost in the top three on the textile exports. The short-term rupee appreciation may hurt, but Arvind as a brand is definitely seeing a lot of expansion, and once they start to realize part of their real estate, that could be the icing on the cake. So I would say a hold and a add would be a good coin over there. ITC has definitely been one of the underperformers, but the valuations and the business is in perfect space. We think this could be in the next 2 to 3 years a doubler from here, given that aside from cigarettes, their other businesses, FMCG, paper, hotels, agris are all performing very, very well, and they are putting more emphasis on that. Cigarettes remains a dark horse coin given the imports and some sort of pressure on from the government. So we think that it should be a status quo at 27, 28 time. ITC becomes a very good play for the next 3 years, and I think the market cap could actually give you a 40 to 50% return in this blue chip. Syntax again has been on part pain because of a highly leveraged balance sheet and the pain they had to give and mark to market because of the rupee. Recently, we've seen Syntax Plastic start to outperform. But like I said, I think if next year we are looking at a very pleasant Diwali, the index being up 25-30%, then I think mid cap stocks can be relative outperformance. On Arvind Mill, the target would be difficult because they've just subdivided. I will get back to you on a mail to you and let you know what we think over a period of time. But definitely, Arvind would be one of the better names in textile, and we think both the that and the hived off arm should do very well in the next 2 years. On SBI again, you've asked me on South Indian Bank and SBI. Now, South Indian Bank again is a proxy to should be seeing gains because of this NBFC fiasco. We think a large part of the pain should be seeing a lot of books on the banking side actually taking up their market share of NBFCs. And that, given that yields are hitting low points, should see good days for South Bank or State Bank. Of course, definitely should see a re-rating given that yields are down and they are going to see write backs on their balance sheet in the next 2 quarters. The management itself has guided almost for a 50,000 crore write back, and we've already seen Bhushan Steel, the Binani cement deals go through, and that would add a lot of value. So we are relatively very bullish on State Bank to be a star outperformer in the PSU pack. BHEL has been a very big underperformer, but I think capex, particularly in the power side, is seeing a lot of traction. And BHEL now from those high 16-17% margin days is down to 8 to 10%. We think there should be some more accretion on the margins. We think that power being in a sweet spot, given the resolution by the banks on a lot of by the government on a lot of environment issues, we should start to see more traction there. At 65, BHEL becomes a good play for a 50% upside, but the writing is that it will take 1.5-2 years. We would rather suggest L&T Cummins to be very key plays and buys on any decline there. On Yes Bank, yes, now this has been one of the stark underperformers given the over ownership of foreign institution investors who own almost 62% and the fiasco of Rana Kapoor not getting a term. The underlying fundamentals remain strong. The bank from a 200 crore capital is close to 50,000 crore in the last 5 years and 15 years. And I think that the fear may be overdone. Short term, the problem is over ownership, and that is seeing a fiasco. We are going to wait for more color from the management on the 13th of December when they appoint or announce the appointment of a chairman or the new CEO. At 160, the stock is available at one-time price to book, the cheapest it has been in 3 years. And if you can sit through the rhetoric, I think it can make handsome money in the next 1 year. Orient Paper, again, paper and rights. Rights is proxy to what we see on the railways and railway development and railway infrastructure. It's a perfect stock, and generally, once we are through with the elections, these type of stocks can be relatively huge outperformers given the emphasis of the government on railway being a very key link. Also, I think Ircon International is another stock which was listed. These are all very good proxy plays to rights is the owner of a large amount of land bank, and that again is on the cards of railways trying to encash some of their land banks, which could add a lot of value to the stock. Paper has been a very strong industry. Orient Paper is part of that. I would again reiterate ITC. ITC Bhadrachalam is the third largest player in the pulp market. It makes all the cups of Starbucks and so on, and they are seeing a lot of traction on the paper side. So Orient Paper becomes a perfect fit. JK Paper, Orient Paper, and ITC become a good fit for that. First Source Solution again has been a relatively better performer given the change of guard at with the Goenkas now taking over. I think this will be a relative market performer. JSW Steel has seen a sharp correction after the one-time entry into the Nifty, but we think at 300 all the negatives are priced in. It is one of the best integrated players and should benefit greatly from local demand rising. President Trump's protectionism has seen some weakness in the metals, and China has been a stark underperformer, which has hurt the market. But we think China is definitely going to be coming back in early 2019. That could be the conduit for metals to do well. TTK Prestige again is a very pedigree company. They have diversified their portfolio, and I think that going forward, this becomes a very good consumption play. They have also told us that they are delving into new verticals, new market availability, online, and so on and so forth. And given the pedigree of the stock, the management, the market share, I still think it's a very good longer term play. JM Financial again is a one of the NBFCs which has hardly any exposure on the NPA side, on ILFS or anything else, and that should be a relative outperformer as a boutique firm. It has interests in everything except as a banking license, just as IFL or an Edelweiss, and I think it could be a market performer. TV18 again is, if you wanted to play the media space, then I think Reliance Jio and Z after this, Z has shown a very strong comeback from that 430 levels. I still think Z can be a relative outperformer given that they are very open to selling a stake. On TV18 itself, I would say that it can be a market performer given that it is garnering market share and the ad revenues are showing traction. On MCX, again, the exchange is doing well and it has garnered more market share, but the competition can definitely come given that NSE is also going to get the license. So we would rather look at some of the banks, particularly ICICI, Axis, and SBI, which are corporate lending banks and which could be huge outperformers going into 2019. The other place which we are very bullish is select. Uh, is a stock called Capital First, where there is a merger with IDFC Bank, and we would see the best of CASA ratio improvement, low cost of deposit, and some the best of MSME along with retail banking, retail client growth over there. On Jamna Auto, Munjal Auto, again, we would again see them to be proxy to rising volumes in the auto. In the OEM space, Jamna Auto, Munjal Auto, Motherson Sumi all seem to fit the bill. And now you should see this quarter onwards, lower input costs definitely adding to the margins going forward. So I would say Jamna Auto, Munjal Auto can be very good outperformers given the sharp correction in commodities, which should add to their margins. And we think volumes in auto should start to see much better traction in early 2019. Symphony again has been a slight underperformer given that it could not make too much inroads into the cooler and the new segment market. I think the valuations have seen a steep correction. It could remain a market performer, but we think on corrections, Voltas, Blue Star could be other consumer durables which can do extremely well along with the Voltas, Blue Star, and even I'm forgetting the name. I'll come back to you on that. Yeah, Nifty Pharma has seen huge traction today. Dr. Reddy, by the way, hit a 52-week high. So if I had to say that Nifty Pharma could actually be a very big dark horse in 2019, given that Dr. Reddy, Lupin, Aurobindo, DV's Lab are seeing a huge amount of traction. We also think most of the issues on the generic pricing in the US may be coming to an end. And 2019 onwards, we think that there could be much more traction on margins and the volumes growing over there. IDFC Bank, like I just suggested, it has a 13.9 to 1 ratio for merger. There is talk that by next month we should be definitely seeing the merger go through. The name would change from IDFC Capital for it would become an IDFC Capital First name. I'm very bullish on Mr. Vaidyanathan. I think his coming will add a lot of value to the bank, and they would definitely see huge upside. I think this stock can be a dark horse in the next 2 years, even doubling from here. Minda Corp again becomes a proxy to the OEM space and has been a relative outperformer recently. But this again sell-off in the mid caps has been a little bit of a pain point. We continue to think that autos and OEM should do well from 2019 onwards. We have a buy on that. IDBI Bank again has been a 5-year. If you have a 3-year window, you will definitely make money. Given that LIC is going to put almost 20,000 crores, and if you gave it a 20 times hiatus to lending, then the order book will be very strong, at least the lending book for the next 2-3 years. We know a large part of the pain as far as the NPS is there, but I think the management change, the proactives. They have the maximum amount of young officers, and on a longer term basis, the book should do relatively well. At 58, 59, there is a buyback at 62. This stock could in the next 2 years give you at least a 50 to 70% return. But I would definitely think IDFC again, sum of parts, the parent company, which is sum of parts, it's the holding company of the asset management, of the NBFs, of the securities arm, of the bank, all sum of parts. Those disinvestments could generate handsome returns. So IDFC at this 42, 43 becomes a good proxy to be at least 65 rupees in the next 2 years. Subros again is a proxy play on the OEMs, and we think that given the pullback in Maruti, all these stocks have taken a big hit. But we think Maruti, on the new launches and some of the impediments being settled down on inventory, on the new insurance, all that could add handsomely to profit in the coming years. That would make most of the OEMs do well over there. Hindustan Copper and HCC, again HCC, I would say try and exit on any rise, get into better reality names like Godrej Property, Shobha, or a DLF, where we still think that reduction of debt is going to add to those balance sheet. Hindustan Copper again has been an underperformer, but the copper cathode, they are the largest player, third largest in the country, second largest in the country, and we think that because of the capex, the stock has underperformed. In the next 2 years, you could see relative outperformance. I don't rule out a target of 100 rupees coming in the next 2 years on Hindustan Copper. On Bisaka and Skipper again is a play on the real estate side, and the management, the group has been relatively having very little NPAs or issues regarding with the bank. So I think it's a steady player. We think next year onward, real estate should be an outperformer. So if I gave you three names, they would be Godrej Property, Shobha, and DLF in that order. We think Prestige Estates or some of the Bangalore players also could do well. But yes, Skipper could be another one which you could add to that name. Print media like Jagran, Prakashan, and all. Now, these are brands which are created, they have a good market share. But given the advent of online, I would still think that in this space, you have to be a little selective. So, Jagran is a good brand. I think you could stay with it, but try and get into on corrections onto Z and Reliance Jio, where we think that the data war, given that the elections will see the highest amount of social media coverage, would be a very, very big point for them, given that pricing is back. Future consumer again is seeing a lot of traction. There is talk of Amazon picking up further stake, and which is telling you that in all this uncertainty, 1 lakh crore has been committed by Walmart. Amazon is ready to buy a lot of players, and we think that the consumption market with this on the consumer side is definitely seeing a lot of traction. So we've seen footfalls rise very, very strongly. The advent of the local banya to the retail market has been very, very good, and that may continue. And we know that both Amazon and Walmart are definitely here to stay. Raymond again is a sum of parts play, one on the brand, two on the what the benefits of the large land bank which they have in and around Bombay, and that has always been the cause for this stock to be, both sides. It underperforms when the market's correct, but it outperforms at 750, 800. I think it has a very good potential. The brand is doing excellent, and we think like after Arvind, Raymond as a brand are definitely two very, very good names. So we think that they could definitely be much more upside in Raymond once we get more on color on the real estate encashment which they do. Insurance and asset management are definitely very good stocks to pick. ICICI Pru, ICICI Lombard, HDFC Life, SBI Life. If you took a basket of these, the next 5 years, you're right, they could be very, very big outperformers. Given that asset under management is just starting, and we think that insurance as a space in a country like ours where real incomes are rising could be a very, very good outperformer. Vakrangi has been all over the place. I would still suggest any rally to use to exit. There have been enough corporate governance issues to deter people from getting in, and I would be uncertain given that the stock saw a huge correction and there is hardly any clarity which emerged. Ashok Leland definitely is one of the another stock which deserves re-attention given that their CV cycle and the cycle on the buses is seeing a lot of traction. Stock from 140 corrected all the way to 105. We think that once you get more color on the 15-year uh, which 15 years of taking vehicles off, that could add to the volumes, and that is debatable. I think the Supreme Court is about to decide on that, but Ashok Leland at this 105 becomes a very good proxy play for rising sales in bus and the commercial vehicles. Yeah, holding company like Grasim definitely has seen a sharp discount, but that was more to do with the sell-off in their retail business in more, where they took a larger than expected loss. But some of parts, given even its own business of VSF, PFY, and the holding company of Ultratech, we think that cement is definitely going to be one of the best performing sectors in 2000 in 2019. So I would definitely use all declines in Grasim, and I think the holding company discount may be unwarranted at such a steep position. If Ultratech is going to be an outperform, then Grasim on the back of its VSF and PFI will outperform. On Penar Industries, I'll give you more colors through a mail. I have to decipher their latest results, and I'll give you a feedback on Penar. So Sundaram Finance would stand out, even though AB Capital at these valuations seems very good. It has some of the insurance business, it has the broking business. But like I said, Grasim and AB Capital had to take a hit on the more business which they divested. There was a huge loss on that on a mark to market, and that's why the stock has underperformed. But definitely the management, both of Sundaram Finance and AB Capital, make them longer term picks. If you can buy and hold, they would do well. Yes Bank made a huge bottom at 147. Management has guided that the divergences are not all that much. It's just a matter of the succession which they have in the realm of getting. So it becomes a good value play at 160, but don't expect overnight the stock to do well. It's a very good brand. It has come down to one time price to book, like I said, and can outperform in the next I would say 6 to 9 months. But let's wait for the color coming from the management, more guidance, and then you could see in the immediate, like I said, the problem is of over ownership, where all rises are being used to sell. But I think it's made a very big base at this 147. Bajaj Auto again would be a perfect play to play the going forward, given that they are eating into market share of Eicher on the Royal Enfield, and that their new brand is doing extremely well. They've accepted some of the problems on their cheaper bikes, and they're trying to realign their portfolio. But I think given the sharp fall in commodities, Bajaj Auto and TVS Motor could do very, very well in 2019. Uh, Cipla. Cipla again has been a underperformer after the quarterly results, even though it has hardly anything to do with FDA issues on their production facilities. Cipla is purely a domestic play, and some of the Seriflow inhaler has made huge market share in Europe. So I think some of part Cipla's this one quarter results have been disappointing. Going ahead, I would expect it to be a market performer to a slight outperformer, but my top pick two would be Dr. Reddy and Aurobindo in the pharma space. Bombay Dye again is a play on the encashment of the real estate, and we think that 2019 could bode well once the election are through for a large part of the real estate bank. So if you are playing for the real estate side, then Bombay Dye becomes a proxy play. Otherwise, it's a holding company of Britannia, that part of it, that would be the ended, and Bombay Burma, where they hold it's a holding company of that. That is some of parts valuation. Marks and Palmer, I would say, convert into Dr. Reddy, Aurobindo, or a Lupin. And PNB, again, I think it has borne most of the pain. But I would say that PSU banks can be relative outperformer, given that most of their asset quality weaknesses are behind. and we think they could gain on the retail and on the loan against property portfolios in 2019. PNB Housing Finance is again a good play, given that it hardly has issues on money, but there has been short-term pain that on the commercial paper withdrawal. But PNB Housing is a very good proxy play. PNB itself has been trying to sell that portfolio, and I think if it one of the larger NBFCs buys that, that could make a perfect fit. But at this level, I think it's a very good play for the next 2 years. Yeah, DLF again. DLF, I would say that the worst may be behind. The company is definitely in the process of reducing large debt on its balance sheet. It is trying to monetize the cyber city asset which they hold. Real estate investment trust, or the REIT, is another way which they want to encash. They want to encash some of their annuity income. The new launches are doing extremely well. I'm speaking to you from Gurgaon, and in Gurgaon they are monetizing a large part of their land banks. And I think at this 160, 165, if you bought that stock, which with a view that it in the order of Godrej, Shobha, DLF, you could make handsome returns in the next 2 years. On TCS, it's been a huge wealth creator. I think this recent sell-off was more to do with the strength in the rupee. I still think that TCS is arguably the best IT company in India and continues to be numero uno. We think they are adapting very well on artificial intelligence, cloud computing. So I would say that TCS is a market performer. Birla Corp again has part cement, part of the other businesses, and that should add value. But we think cement itself is in a very sweet spot, given that we've had a low quarter of housing growth, and we think that once this NBFC thing is sorted, which is on the anvil, we should see much more traction on on construction, both commercial and on construction and on the commercial side. On one liquor stock and ethanol recommendation, I would say that Balrampur Chini would be my preferred pick there. It is one of the largest players on the ethanol side. And on liquor, I would be very bullish on United Spirits, even though the stock has been an outperformer. Given that Diageo has been able to make a very good franchise model, and secondly, their earnings have shown a huge, much better margins than what is expected. The only underlying fear remains the prohibition, which I think is there just till the election. Once that is over, I think United Spirits and Balrampur Chini fit the bill perfectly. Escorts again is a very good proxy play to tractor sales, and they have improved their portfolio greatly. We think that given that MSP has been raised, we think the rural incomes are definitely going to be the surprise packet on the upside, which could spur more tractor sales, and their portfolio should do well. Federal Bank is definitely a very, very good stock. It saw a lot of weakness because of the one-time Kerala floods. The management has guided very positively. It has taken that hit. And I think that a Federal Bank from here, even though it has moved up from that 70 level, becomes a perfect fit for a 50% upside in the next 2 years. So multi-baggers are difficult to give, but if I could suggest, that I think that some of the construction plays, Nagarjuna Construction, NBCC, have borne large part of the pain. They seem very, very good on the next 2 year on a 2 year basis. They look very good. We like some of the ferrous, non-ferrous stocks like Hindalco and Vedanta. At these levels, they are giving you a lot of the opportunities. I already mentioned Capital First. I think L&T on any decline, L&T Finance as a NBFC is doing well. And as and when we get any other multi-baggers, we'll definitely keep you updated. If you can live with the pain, CG Power came out with very weak quarters, more so on the overseas borrowing which they had, the mark to market, and uh, some of the over leveraged debt which they had to pay, which hurts the return on equity. The company is in the process of selling some of the Belgian and Brussels assets, and that is very much a deal on the cards. Some of parts on the power space, I think this becomes a very good play at this 37, 38. You could look for levels of 75 in the next 1.5 years. We have heard that March 2019 should be the ballpoint day, where month where they could actually come out with a clear guideline for reduction of debt, and that would be the silver lining. At this price, I think this stock has a potential of doubling in the next 1.5 years. Also, I'd like to tell you, for more updates, kindly look at uh, uh, please subscribe to the uh, IIFL Market YouTube channel. That will let you that will see all your queries being answered, and we will keep this interaction more regular so that we can solve your near term and longer term issues on the market. I would like to also state that IFL, the asset management company, has a very, very robust PMS scheme. They have a PMS which has a hedge, also a natural hedge where the downsides are limited. So any of you who are grappling with the volatility, the IFL hedge PMS is very, very attractively poised. And if you want a pure and simple vanilla PMS, then they offer that also. Both those are very good performance oriented schemes which we have, and they can do relatively well. So I think I'll take leave. It's been a pleasure with all of you, and we hope we can serve you better in time to come. Thank you, and good evening to all of you. And